Good day, traders. Chris Weston here, Head of Research at Pepperstone. So today I really want to talk about the equity story because it's absolutely fascinating to see that we continue to make these new all-time highs in the S&P, the Dow, and certainly in the NASDAQ. European markets look fantastic. If you look at the DAX, it's broken out to new all-time highs, whether you're pricing that in euro terms or a foreign currency like the US dollar, it looks very, very strong at the moment. Australian markets haven't made that new all-time high, but we're not a million miles away from that. And we've seen this strong rebound coming through in Chinese equities. So I want to touch today a little bit about what's caused those moves. There's not one smoking gun, and we continue to hear from clients saying, when will valuation matter more? You've got the S&P trading on 19 times forward earnings. We've never been that expensive. When will valuation matter? When we'll get an end to this liquidity-driven market, and when we'll start seeing better shorting opportunities coming through in this market? But for me, at the moment, if you have a look at the chart of the Dow or Wall Street, you can see that 4.1% pullback between the 17th of January to the 31st of January. And now we've gone on, made a new all-time high. The S&P is trading at all-time highs, and we're about 5% away from analyst 12-month forecasts in terms of where they see price targets. The NASDAQ's been the poster child of momentum, and certainly that's been a proxy of what's happened in the bond market, which I'll touch on in a moment. But certainly, if you're an active fund manager and you need to benchmark yourself against the MSCI World Index or against the S&P, you're looking at these staggering gains, not just month to date, but certainly year to date, and saying, am I outperforming? And certainly you're starting getting to that FOMO-driven rally again. So certainly, markets look pretty good at the moment, and certainly the interest we've seen with clients to go long and short as well suggests, getting a deeper dive into these equity markets. But for me, one of the reasons why we didn't see a deeper pullback in the Dow, the S&P, and the NASDAQ and some of these other markets is because a lot of the institutional funds are running what we call a barbell strategy. And if you have a look at the chart here, on the Bloomberg chart here, you can see the S&P in white, and you can see that modest pullback, this rebound. We've gone on to new all-time highs. And what people have done is effectively they've been long of short stocks. They've been long S&P futures, long NASDAQ futures, or whatever the market is there. And they've hedged themselves by being long US Treasury as well. I've looked at here at the 10-year real yield, which we've got, which is basically the inflation-adjusted bond market. And you can look at 10 years, or you can look at the inflation-adjusted number here, and you can see that's been moving lower. So people have protected themselves by being long treasuries. You can see the gold price there has been holding up pretty well. So people have been using gold as a hedge there. So people are long stocks. They didn't want to reduce those positions because they've been hedged against US Treasuries and gold. It's what we call a barbell strategy. That trade's been unwound somewhat in terms of treasuries, but that still remains. And for me, why we didn't see a bigger pullback is because people are hedged that equity exposure using the bond market. But also, I think we need to take an understanding that when real yields or nominal bond yields are trading very, very low levels, in terms of the case here, the 10-year real yield at negative rates, if you're looking as an equity investor at the future cash flows of a business, and you discount those future cash flows based on a set of assumptions, so you discount that back to the present value, the lower the discounting rate, which in case we use the treasury market here as a risk-free rate, the more compelling those cash flows are, and the higher the net present value. So for instance, in this situation where bond yields are falling, it makes those cash flows of the businesses much more attractive. In the case of the NASDAQ, where you get those really high cash flow, high PE, high momentum, high growth names, that's why the market there has been outperforming. So for me, the main reason why we've been seeing this is, one, we've got the barbell strategy, but secondly, as real yields have been moving, as you can see there in the purple, or the sort of the pinky line there, the cash flows of those businesses have been reinforced. So as long as real yields are staying low, and we don't see that snapback, that sell-off that causes real yields and nominal bond yields to move up, people are going to continue to support equity markets there. So the bond market, I think, is the real driver of the equity market. I think the equity market really is a function of what's happening in that discounting process. That's not going to necessarily change any minute now. Have a look at the quality of the journey. I like to understand why something's going from A to B, but the quality of that journey. Of course, price tells us a lot about the quality of the journey in terms of what's happening in the S&P. But have a look at some of the other aspects here. What I want to see is the small caps outperforming large caps, and we can see that from the top pane, where we have a look at the Russell relative to the S&P. You can see there's been a little bit of outperformance from the Russell relative to the S&P, which is the white line. So we're looking at that as a ratio, the Russell price divided by the S&P. That had been big underperforming really since the start of the year. We've been seeing small caps underperforming large caps. In a really bullish market, what you want to see is obviously small caps really outperforming, and I think the Russell's a much clearer sign of what's happening in the cyclical focus. It's much more driven by the real economy rather than going going out to the sort of global companies who are sourcing revenue from offshore. Now, we have seen a bit of a snapback. So this recent move that we've been seeing in the S&P, we have seen a slight outperformance from small caps, but it's still unconvincing at this stage. On the yellow line there, which is the middle pane, you can see the Russell Growth Index relative to value. In a times when you're going to see that value starting to make a bigger proposition, you're going to see this moving lower because value is effectively the denominator in this situation. But what we're still seeing is growth continuing to outperform. If you have a look at the bottom pane, which is the green line, just again, we're starting to see the quality of this move up. In a really bullish market in the S&P, you'd be expecting to see cyclical sectors outperform defensive sectors, which we've used again as a ratio. So the cyclical sectors are effectively the numerator, defensive being the denominator. So when this is moving up, we're seeing cyclical sectors really outperforming. That's kind of what we've been seeing for much of February. We have been seeing that cyclical sectors have been moving up. Again, we're talking about the quality of the journey, and from those indicators, it suggests, things are looking a little bit better. We can also look at things like the Philadelphia semiconductor index, and that's had a nice move up over the last 4 days. That's at all-time high. Dow Transport's also moving up to all-time highs. I like to have a look at what's happening in the credit markets. Equity markets always look at credit, and what we've had a look at here is the white line. You can see high yield relative to investment grade credit, and when this is moving down, it tells you that the high yield credit spreads are moving and narrowing relative to investment grade credit spreads. It tells you that people are happy to buy investment high yield credit, take that risk that you've been seeing there, and high yield is outperforming investment grade, which of course is lower risk, higher quality. And we can see there really the last couple of weeks that high yield credit spreads have been narrowing relative to investment grade. We've seen a number of junk bond rated companies going out to the debt markets. That market's looking pretty hot again. Equity markets will take that every day of the week. If we're seeing a lot of the debt, high yield junk debt coming out and issuing and getting that paper away very, very easily, equity markets are going to find solace in that situation. I also like to look at market internals as well. If we look at the New York Stock Exchange advanced decliners, have you looked at the 5-day moving average here? That's still fairly upbeat. You can see the number of companies at 52-week highs at 74%. It's not at extremities. I like to look at this one just in terms of participation throughout this rally we've been seeing, but also are we at a point where there's too much euphoria baked into the cake? Has that elastic band been pulled too far? If we have a look at the number of companies at 52-week highs, 74%, I'd be a bit more concerned if that was pushing over sort of 90%. As we saw back in January, that actually got up to much higher levels there. Number of companies with price at above their 20-day moving average, 72%. Not too concerned about that, but it has been higher and it's been moving up, so there has been good participation. Number of companies above that 20-day moving average has been moving higher. You can see a number of companies above their 50-day moving average, around 70%. Again, last couple of weeks that participation has moved up, but I'll be a bit more concerned if that was getting to above sort of 80-85%. And then we've got the number of companies above their 14-day RSI sitting at 13%. Again, if that was trading towards sort of 20-25%, I'd be a bit more concerned. So we are at levels where you can see that these market internals have been moving up over the last 2 weeks. It shows some good participation within the rally. Of course, people talk about the poor breadth. This market has been dominated by big tech, and the S&P has been driven by a number of small companies. That breadth has been quite poor. But what we can see from the number of companies above their moving average is that they have been all moving up in unison. There's been reasonably good participation in here, but we're not at levels where I'm really too concerned about the level of euphoria that's baked in. It is moving up, and we've got this on the radar, but we're not quite at that level as well. I have a look at what's happening in options market. If you have a look at the lower pane here, you can see that the put call ratio has come down to 0.56. So people have been reducing those puts. If you look at this relative to the mean, which is the blue line over the 5-year average, we're coming down to multi-year lows. So people have been reducing those puts, which obviously give you that downside protection. So people have been unwinding those portfolio hedges. If you have a look at implied volatility, which you can see on the top pane here, and if we have a look at 1 month 25 delta, call implied volatility minus put implied volatility, you can see that puts effectively are trading at a 4.6 vol premium to call volatility in the S&P. Now that tells you that people have still got that put protection in place, but those implied vols have come back to much more neutral levels. Though you can see there that red line has been moving up. That tells you that put volatility has been closing back down to or reverting back to where call volatility is. People have been therefore again reducing those downside protection portfolio hedges over the last couple of weeks. Now, in terms of what's actually driven us here. No, I think obviously people have been talking about liquidity. Equity markets love the fact that credit spreads have been narrowing, but people love the fact that we've seen better liquidity conditions. And if you have a look at the blue second pane, you can see that's really been about what's happening with the PBOC. The PBOC have flooded the markets with liquidity. They've really tried to contain SHIBOR and HIBOR rates, and you can see there on the blue line the net new money that's come into the markets there has been quite high. That's been something that equity market traders have been looking at quite closely. I will say that if you have a look at the money supply numbers, which you can have a look at the pink line, that's been sort of coming down a little bit over late. So people have been looking at money supply and saying that's been had a decent correlation with equity markets for some time. But money supply globally has come down a little bit over the last week or two. The G3 balance sheet as well is continuing to move up. So liquidity still continues to be a dominant theme, but I'll be looking more closely at what's happening in the PBOC and their liquidity measures there as well. Data, well, certainly in the US, if you have a look at the Citigroup Economic Surprise Index, that's been pushing up. So we can see the Economic Surprise Index tells me that US data has been beating consistently. This market will move up. This index will move up when the actual data print comes out above the expectations of the market. And as you can see, the last couple of weeks, that's been moving up more aggressively. And I think that's been probably part of the reason why the US dollar's been strong. But the equity market likes the fact that central banks continue to underpin this market. They've got a flexible stance. They've got a flexible mindset. But the data in the US has been quite convincingly beating expectations over the last couple of weeks. In terms of earnings, you can see here that the number of companies beating expectations has been pretty good. You can see from the Bloomberg chart that we've had, I think, 73% of companies thus far have come out in the US with Q4 earnings. 74% have beaten on EPS, which is kind of in line with just a bit above expectations. 66% have beaten on sales. Those companies that have beaten on earnings have beaten by an average of 5.4%, and we've seen about 3.5% sales growth. So given everything that we've been concerned about in terms of bottom up and micro story, the earnings have come out slightly better than expected as well. The other thing is what's happening in US politics, and if you have a look at this chart, you can see on the bottom pane, the prospect of Bernie Sanders becoming the Democrat nominee has picked up to 47%. That's really been moving up in the wake of New Hampshire and polling pretty well in Iowa as well. But the market is saying, well, if we've got a Bernie Sanders potential nominee situation, then the chance of Donald Trump getting re-elected is increasing, and you can see that from the white line on the top pane, which shows you the prospects of the Republican Party winning according to predicted. So you can see that's sitting at 57%. So what's happening is Bernie Sanders' prospects of becoming the Democrat nominee have been increasing. The market's been saying that therefore that the chance of Donald Trump getting re-elected are higher because he should walk the floor with Bernie Sanders. Now, I'm not saying that's going to happen. Obviously, the market would be somewhat surprised if Bernie Sanders win. And I think we'd probably get a bit of sizable drawdown in markets, but we can't rule that out. But the market's saying at the moment the higher chance of the Republican Party getting a re-election is part of the reason we're seeing the S&P moving high. Now, it's a spurious correlation, but the markets are moving quite closely together. So I think there's been this kind of repricing of election risk. The market's saying Bernie Sanders, higher chance, therefore we've got a continuation and a higher chance of Trump getting re-elected. So what causes an equity sell-off? Well, I think there's two things that really spring to mind. One would have to be a change in liquidity dynamics. If the market saw less liquidity dynamics playing through in China, and also we did see that global money supply continuing to go down, which caused the market to really look at that more closely, then I think you could see that valuation starting to matter a lot more closely. The other issue, of course, is what happens in the bond market. If we saw real yields moving sharply higher, and of course that's a big if because we're going to have to see something change, and that would need to see a more hawkish stance from global central banks, which of course is not going to happen. They target financial conditions. then I think if real yields were to move up, and the rate of change obviously very key, then that valuation would matter too much, and we would see much greater shorting interest from those markets. If we saw commodity prices really rolling over, I think that would be another issue, taking another leg lower as well. So I think for a substantial move lower in these equity markets, we're going to need to see liquidity being changed. We're going to need to see people selling out of bonds, and that barbell strategy changing. Until that time, I think the prospect of people buying dips and this FOMO chasing rally and new highs in the equity market continues to be the case.